The largest line item in most clients' monthly cash flow is the mortgage payment. It doesn't appear on your statements, it never gets rebalanced, and it was structured by a lender who never spoke to you. This briefing treats it the way you'd treat any other position, as an allocation with a cost, a holding period, and a liquidity profile. A representative client, $600,000 mortgage, 6.25%, 30-year fixed. The payment is $3,694 a month, $44,332 a year. Over the full term, $729,949 in interest. That is more than the loan itself. The problem isn't the total, it's the sequence. 85% of the first payment is interest, not principal. After 5 years, 60 payments, $220,000 out the door, the client has retired $39,977 of principal, 18 cents on the dollar. A 30-year amortization schedule is an asset allocation decision. $44,000 a year for 3 decades committed to a single, illiquid, non-diversified position during the client's peak earning years. The question isn't whether 6.25 is a good rate. It's whether 30 years is the right holding period for that cash flow. The mechanism. The all-in-one is a first-lien home equity line of credit with a sweep checking account built into it. One account, one lien. The client's entire paycheck is deposited into the line, not an extra payment, the whole deposit. That deposit reduces principal the day it lands. Interest accrues on the average daily balance, so every dollar in the account offsets interest for every day it sits there. Idle cash earns a return equal to the loan rate. The client pays bills from the same account, and the balance rises again as they spend. It operates as their checking account, not a savings vehicle they have to remember to fund. There is no formal monthly payment. Accrued interest is debited on the 21st. The spread between what they earn and what they spend retires principal automatically, every month, with no transfer required. 2 structural points. This never converts to an amortizing loan, and it's available on primary residences, second homes, and investment properties. The math, with assumptions stated. Same $600,000 loan. The all-in-one starts at 6.88%, SOFR plus a 3.25 margin. That is a higher rate than the 6.25 fixed. The client takes home $10,000 a month. Living expenses, excluding the mortgage, run $3,806. That leaves roughly $2,500 a month of surplus, the same surplus they had while making the fixed payment. No lifestyle change. Holding the rate constant, the line retires in 11.6 years. Total interest, $263,607 against $729,949 on the fixed. $466,000 of interest never paid at a higher nominal rate on the same budget. The advantage is structural, not a rate advantage. Across a realistic range of rate paths, payoff lands in a 12 to 14-year band, roughly 18 years earlier than the fixed. This is an illustration on stated assumptions, not a guarantee. At payoff, the $3,694 obligation disappears. Earning capacity does not. The client is at peak income with no mortgage payment, roughly 18 years before the fixed loan would have released that cash flow. Directed into the portfolio for 15 years, contributions total $665,000. At a 6% annual return, roughly $1.07 million. At 8%, roughly $1.28 million. Those are hypothetical illustrations at constant returns, not projections, not any specific investment, and not a recommendation. Real markets don't deliver constant returns, and sequence risk applies. The structural point holds at any return assumption. Accelerating the payoff manufactures a decade and a half of new contribution capacity during years otherwise spent servicing amortization. A client can accelerate any mortgage with extra principal payments. The difference is liquidity. $1 of extra principal on a fixed mortgage is gone. It bought a guaranteed return equal to the loan rate, but it is illiquid. Recovering it requires a refinance or a new home equity line, application, appraisal, underwriting, closing costs. It also requires qualifying at the moment the money is needed, which is often the moment qualification is hardest. On the all-in-one, every dollar of paydown stays available on the line. By year 5 in the model, the balance is $397,000, with $202,000 of available credit. By year 10, $486,000. On the fixed mortgage, accessible equity across that decade is zero without a new transaction. The client holds a liquidity facility secured by the residents at mortgage-level pricing for the full 30-year term. A capital call, a business purchase, a market dislocation. They draw. No application, no closing costs. Rate risk. The rate is variable, SOFR plus a margin, generally 2.5% to 4%. This example uses 3.25. The lifetime cap is 6 points above the start, so 6.88 carries a ceiling of 12.88%. The break-even. Run the same household cash flow at successively higher constant rates. At 7.88%, the client saves $394,000. At 8.88, $300,000. At 9.88, $171,000. The crossover, where the all-in-one's total interest equals the fixed loans, is approximately 10.8%, held constant for the entire term. 2 disclosures follow from that. First, the crossover sits below the 12.88% cap. A rate that climbs near the ceiling and stays there erases the advantage. That is a real risk, and any claim that the cap cannot hurt the client is wrong. Second, the magnitude required. 10.8% implies SOFR near 7.5%, given the 3.25 margin. SOFR tracks the federal funds rate closely. As of the July 29th Federal Open Market Committee statement, the target range is 3.5% to 3.75%. That is roughly 4 percentage points of tightening from current levels. Because break-even assumes a constant rate, a temporary spike does not reach it. That level would have to persist for most of the loan's life. The Fed has exceeded 7.5% before, in the early 1990s and above 20% under Volcker. Each of those episodes responded to double-digit inflation, and none sustained that level for anything approaching a mortgage term. The current policy debate is measured in quarter points. Assess the probability on magnitude and duration, not direction alone. The asymmetry runs the other way as well. If rates fall, the client captures it automatically, with no refinance and no closing costs. A fixed-rate borrower must transact and pay to participate. One further disclosure. After year 10, the credit limit steps down by 1/240th per month, $2,500 a month on a $600,000 line. A client on the modeled pace finishes before that binds. A client behind that pace must plan for it. 3 implications for your practice. First, positioning. The mortgage is the largest item on the household balance sheet, and it typically sits outside the advisory relationship. Raising it extends the scope of advice to the full balance sheet. Second, capital flow. Recaptured cash flow has to be deployed somewhere, and disciplined households tend to direct it toward the accounts already under management. Third, the conversation is a planning question, not a product pitch. Mortgage-free in 12 years instead of 30, with the payment redirected into the portfolio for the 18 years in between. Suitability limits apply. This requires qualification, genuine surplus cash flow, and tolerance for a variable rate. It is the wrong instrument for a thin-margin household or for a client who will not tolerate a moving rate. For a disciplined, high-income household with a stable deposit pattern, it warrants consideration. The next step. Send a client's numbers: loan size, income, deposit pattern, monthly expenses. I'll run the simulation on their actual cash flow, and return both scenarios side by side, including the cases where the all-in-one is the wrong answer. No cost and no obligation. You bring the client a structural option their prior lender did not present. I handle the financing and the disclosures. Contact information is on screen.